Each of these have such a fascinating story behind them. So great for a podcast. That's all we have, all the time we have for the mailbag, because I want to get to your high conviction ideas, your pro picks. ProPicks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Okay, let's get into your high conviction ideas. Your first one is Chartwell Retirement Residences. You've already said you love seniors housing. So you're picking Chartwell as kind of the horse that you're betting on in this segment. What do you love about it? And, the fact that it has run up, is that a deterrent to you at all in terms of valuation, whether it's trading at a premium?
It's not trading at a premium to our view of net asset value of this enterprise. And I would note one of the reasons we like Chartwell, and we'll talk about the sector, we like the sector generally in the United States and Canada, but you have comparable names in the United States trading at 50 to 90% premiums to net asset value. Real estate, so Welltower, which is a very large enterprise, it's trading like a high growth healthcare name, not a real estate name. Ventas trading at big premiums. So Chartwell, higher growth, the biggest player in Canada. Secular tailwinds are through the next 20 years in terms of the aging of the population. Limited new supply. So 15 years ago, there was a lot of supply of retirement homes. Anybody had a great real estate piece of land, they wanted to buy a retirement home. You can do the best real estate deal in the world. If you're not a strong operator, it's like hotels. It's primarily an operating related business. So Chartwell, as a largest and very capable operator, is really well positioned because there's no new supply. These folks learned their lessons. So supply and demand looks good. Value is quite reasonable. Leverage is conservative. Strong management team. A year ago, they came out, they said they were about 82% occupancy. They told the market they were going to be 95% by the end of 2025. The market was skeptical. We were not. They're like 94% today, and we think there's a likelihood they're going to exceed it.
You said the U.S. equivalents are trading at a 50 to 100% premium. Chartwell's trading at a discount.
Correct.
Is it your view that they should trade at a 50 to 100% premium, or that even a little bit of a adjustment to the U.S. peers is where you can get your upside?
I don't think they should trade at a 50 to 100% premium to NAV, but I do think this enterprise at this time frame, based on the very favorable fundamentals, warrants a premium for a number of reasons. And we saw Welltower by Amica earlier this year. I mean, it was private, so not a lot of disclosure. But if you were to apply the valuation metrics that Welltower bought Amica, which is Canadian retirement homes, I suspect that would be a very significant premium for Chartwell looking at their forward-looking net operating income outlook.
So stock trading at $19, already up 30% so far this year, and you see it. What's your net asset value? We're
at about $22.
Okay, so a bit of upside from
And
here.
you get a nice dividend while you wait.
Yes, 3%.
Yeah.
Dream Industrial REIT. We've talked about the Dream Complex. What do you like about what's happening at Dream Industrial, which has, it's perked up since April, let's call it that, but certainly not the same trajectory as a Chartwell?
No, I mean, this is a cheap stock. It's been hit by concerns over tariffs, and we'll come back to that. And bit of a pall on the sector. But what one needs to understand about Dream Industrial, they're in the industrial sector by definition of their name, is not manufacturers that are going to be hurt by tariffs. It's distribution related to our local economy. It's a very attractive dividend on this name. Don't ever buy REITs for yield. Total return is what counts, but the yield is part of that. 5.6% dividend yield. Stock is cheap. Our view of net asset value is around $17 per unit. So here you have a stock at $12.50, paying you a 5.6% distribution yield, that the value of the underlying real estate is $17. Well-managed enterprise. And we think, any improvement in the tariff picture is certainly a boost, but we didn't buy it relying on that. They have a great joint venture. I mentioned Summit earlier. Summit, this was bought by GIC, Government of Singapore Pension Plan, bought Summit. They partnered with Dream. There's the operating platform, so they're generating management fees on their GIC partnership. They're using GIC's balance sheet to grow. We think the stock is cheap, management is strong, and we think this continues to appreciate.
Your third pick, you love grocery anchored, so First Capital REIT kind of fits into that. And I'm curious how you think about holding this. You've mentioned certain sectors like office, not a buy and hold sector. Maybe you can catch it as a trade. And it looks like First Capital, over the last couple of years, it tends to top out at a certain level, call it $18, $19 a share, and then it pulls back. And now it's back to that $19 level. Why do you like First Capital as a theme? And then how do you think about how it maybe breaks out of its
So
range?
this is most of our core holdings at Vision, our long-term core holdings, and this is certainly one of them. We've been pretty public on our conviction on this name for some time, and I've stated, and I'll state here, this is the highest quality grocery-anchored shopping center portfolio in the world. That's a bold statement.
That is a bold statement.
Even for Vision, that's a bold statement.
What makes it so?
So again, I have a long history in my former career leading financings for them, and I got to see this portfolio created. And it's created in the 6 major urban centers in Canada. Toronto, about 50% of Toronto. It's 75% Toronto, Montreal, Vancouver, rounded out by Calgary, Edmonton, Ottawa. There's no fashion here. There's no power centers here. There's no secondary markets here. So it's the best located shopping centers in the heart of 6 growing Canadian cities. They have stability from the grocery anchor. And as I mentioned earlier, the ancillary tenants are necessity-based. There's about 20 million square feet of in-place grocery-anchored shopping centers and 22 million square feet of incremental density to add value on those sites, not greenfield land, but in these locations. Now, that's not worth as much as it is a year ago because of the condo market, but long-term, it's part of the value to it. They've done a good job operationally recently. They've been increasing their net operating income. Their bad debt is down, and they're still trading at a discount. Supply and demand fundamentals strong. No new supply. There's been no new supply in this sector again. So demand resilient, grocery anchored really helps that.
I mean, this was a messy story for a while, and I believe you got involved. Did you get involved on the activist side? You and Manny Ewing Morris, who we've interviewed. Anson, I believe, was also involved.
Not sure about Anson, but
I could be wrong on that.
Sandpiper was involved.
Sandpiper, yes, that's the one. And Dory Siegel, of course, the founder and former CEO. So how did you get from your discontent with the company a few years ago to today?
Our view at the time, and we weren't front and center in that debate, Ewing Morris and Mr. Siegel and Sandpiper certain were, we tried to play more of a constructive role behind the scenes with board members we knew well, CEO we knew well, and it resulted in a 2023 cooperation agreement where people really understood Vision's involvement for the first time publicly on that day, where we brought Ewing Morris and First Capital together to have a positive resolution that resulted in a new chairman of the board. At that time, it resulted in Mr. Richard Nesbitt being appointed to the board. Richard, full disclosure, on our board, former president, Toronto Stock Exchange, former chairman and CEO of CIBC World Markets. And earlier that month, Ira Gluskin had been appointed to the board, who wasn't our nominee, but he's on our board as well. And so there was board change, and they addressed and announced what they called their capital optimization process, where they've been selling low-yielding assets with low income and redeploying that capital to reduce leverage, buy back some stock, and some of their growth initiatives. And so, that was a positive outcome at the time. We were very critical of some of the most, and have been critical about some of the worst capital allocation decisions we've seen, which was in 2019. The REIT levered up with a lot of debt to buy out major shareholder Gazit, which Mr. Siegel had been affiliated with, in order to get rid of the sponsorship. That was a dumb move. There was no accountability for that at any point in time. Wrong point in the cycle to add leverage. And they've been basically unwinding that for 5 years. And so we were critical of the board in some of the governance in capital, but the assets are amazing, the markets are great, and the real estate speaks for itself.
And an example of not a CEO change to catalyze that. Is that right?
That's correct.
CEO that you were unhappy with is still the CEO now.
That's correct.
But now you're on side with the things that they're doing.
Well, we still are active on the file. We still have governance concerns there, frankly. We were public at the annual meeting. So that's in the public realm. We think the board operates more of as many boards do, as a club. We've used that word. They don't like it, but it's I think a very...
So what changes would you like to see done?
We'd like to see more active shareholder aligned. There was a lot of interest in acquiring this REIT. The stock price has done well, and so that validates perhaps the governance path at the time. But there's a lot of interest in this asset class, and the debates we've had with some board members is that everybody knows we're for sale, Jeff. If somebody wanted to buy us, they come to see us. In my experience, both in what I've been doing for 18 years and as a banker for 15 years, it's a very different outcome when you have a process. It doesn't have to be publicly announced, but a process where people have some certainty of transaction versus it's motherhood. Every entrenched board you've ever says, of course, we're always receptive to a transaction. That's motherhood. It's irrelevant. When you have an independent investment banker managing a process and there's some certainty, like the Blackstones and Brookfields, they won't do anything unsolicited by corporate philosophy. So they need to be invited in to do a transaction where they have some confidence that if they spend the time and money, it's a lot of money, to go through these processes, at the end of the day, there's a reasonable likelihood there will be a transaction. The market does not have that confidence in First Capital.
And you'd like them to start that process?
I think they should have started a long time ago.
Jeff, this has been so fascinating. I feel like I could do another hour, but my producer will she's over there shaking her head. So great to get time with you. Thank you so much. I learned a lot.